So in honor of everyone being back to school, we thought we would go back to school here at 10 Capital with a 4-part series we're going to be doing over the next month on our investment philosophy that will break things down to the simplest level to help investors know if what they're doing is working. So as part of this back to school series, we're going to look at, again, in our opinion, the fundamental ways clients can look at their investments to better understand if it's working, which is always what's on people's mind. Today's looking at the realities and challenges to trying to have an objective-based approach to investing. Now, of course, objective can have two definitions. One is to be unbiased. That perhaps creates the backdrop to everything we're talking about, which is there should be nothing governing one selection of investments other than what's best for the end client investor. Of course, that's not the reality in most of the industry. Has value propositions around their stock picking prowess or house product or a different type of product they're being incentivized to push. As an independent firm, obviously, we believe that ability to be free of conflicts of interest is critical. What we're focusing on, though, specifically in this series is objective as defined by like a goal or purpose to one's investing. Today, we're going to take a quick look at what are 4 of the most common ways we see investors thinking about why they're an investor and the challenges to that actually being the type of thesis-based investing, which will be really the subject of next week's talk, to have them have an effective way to evaluate and stick to a plan. So what are those 4 big ways? I've wrote them down here on this board. 1, make money. 2, a reasonable return. 3, beat the S&P 500. 4, get a conservative income stream. So when we asked around and again even talked within the group of what they frequently hear, these were in order the top 4 things we saw. Here's the reason why having a broad why doesn't cut it in terms of its level of descriptiveness to be an actual thesis, and we'll again get into more of what that means next week, but on a why level. Make money. The problem with this being your benchmark for whether something is working or not is the market, broadly speaking, whether it's stocks, bonds, real estate, they go down a lot of the time. And so how are you going to, again, know if now this means it is or isn't working? Looking at the most common proxy benchmark that people look at, the S&P 500, 50% of days, roughly historically, the S&P is down. About a third of months, about a quarter of years. Over 65% of the time, there's a drawdown in the market of 5%. And again, I can tell you after being at this for 20 years, market drops 5%. Everybody calls to find out, is this going to be a 10, 20, 40% type correction? With respect to 10 plus or minus type correction, that still happens almost 50% of investable years going back to 1980. So again, there's just going to be a lot of times, moments in time, that could trip you up, frustrate you if you haven't defined is it working and why you're investing, both in general as well as specific to individual asset classes other than make money. Second, a reasonable rate of return. Sounds reasonable. The problem with it is it's usually based off historical averages, and the problem with those averages is they rarely ever happen. Again, just taking a look at the S&P 500 is usually a dominant part of people's portfolios. If an average return would say be between 5 and 10%, and we look back at the last 90 years in the S&P 500, that's only happened 9 times. And so again, this average return people are looking for, this reasonable rate of return, is rarely going to happen. How are you going to react to that? If it's a really great year in the market, is that going to lead you to be more greedy? If it doesn't hit that goal and it's less than, say, 5%, is that going to create fear and frustration that leads you to change your tact? Either one of those can lead to a lot of danger, whether it's giving up or, again, getting too greedy in one's investment portfolio. Number 3, beat the S&P 500. Very common response we hear, particularly from the men that we talk to. Issue with this is, again, 95% of managers fail to beat the benchmark. It fails to map to most people's needs around that LIVE acronym of needing greater income and some volatility buffering for the behavioral finance side and the emotional side of being an investor. So again, you're setting yourself up, if you will, for frustration. On that behavioral finance side, that's where the client failure comes in. Again, it's very difficult to just ride the waves with all of your money in the S&P 500 or to invest in an asset class that historically has beat the S&P 500, the Russell 2000, that has 50% even more volatility than the S&P 500 historically. The lack of income, the amount of volatility is just going to more often than not, again, be problematic for one's life events that occur and or the emotional trip-ups. Finally, conservative income. This is, those people who come and say, hey, could you do better than the bank account? That's obviously been a common refrain in this low interest rate environment. The issue here is the broadly used term of conservative. Most people throw that term around whether it's fully defined or not. Most of the time it's not. They mean don't lose money. The problem is outside of a federally insured CD, investments can gain and lose money. We won't get into insurance products and their potential benefits and pitfalls right now. But again, as bond investors have found this year, while they do a great job of dampening volatility, even when they're down, they can go down. And so if that expectation was, well, I didn't expect this conservative investment to lose, that's going to trip people up. You mix all this with the fact that market timing rarely coincides with your timing, and the pros and cons of diversification in the sense that there's always something in there that may not be living up to what you think is one of these expectations. There's lots of chances, again, with a broad-based why, of getting tripped up and becoming one of those people that starts chasing asset classes and past performance. With that, we're going to cut it for this week. Next week, we're going to look at what it means to be a thesis-based investor to achieve better success.